In order to develop a high-probability trading strategy with a lower risk-to-reward ratio, we started research on ICT's old concepts, such as time and price theory, as well as AMD's power of three principles, first discussed by ICT 6 years ago. Our research resulted in three rules and one theory that you need to apply in your candle range trading plans. For example, if the first candle forming the range experiences a violation, it won't be safe to trade using the CRT model until it meets our conditions. This is last week's live chart of Euro USD. By fully understanding the strategy in this video, you'll see how we successfully traded the specific candle ranges for profit and knew when to avoid trading others. So, let's start with this question: how we can determine high-probability CRT candlestick formation on the chart. In the bullish scenario, the candlestick base CRT typically refers to a three-candle sequence on the high time frame, like daily candles, where the first candle forms a range based on its high and low. The second candle absorbs the liquidity of the first candle through the formation of a wick, after which the third candle breaks out of the range. Three important rules will help to identify high-probability CRT patterns. The first rule: the CRT model is not limited to a three-candle sequence and can be formed by a series of multiple candles or even just one candle. For example, in this candle series, we can see that multiple candles are formed to hit the range candle's highest point. So, the price formed a range candle followed by an inside bar. Then, we had a sweeping candle that swept below the range with a shadow, and then the price formed multiple candles until it touched the high of the candle range. The second rule: at the formation of the first candle that creates the range, if we identify a candle violation, this candle's range will not be safe to trade using the CRT model until it meets the theory we will discuss in the following. The third rule: if the second candle surpasses the range of the first candle in the accumulation phase with its body, it should not be viewed as part of the manipulation phase. In this case, there is a chance of the trend continuing in the direction of the first candle. Here we have some CRT models that meet these three rules. The first scenario highlights the critical CRT model, which has a high probability of success. This is because it incorporates the accumulation, manipulation, and distribution phases within a three-candle sequence, leveraging the power of three. All this process starts with the accumulation phase. But what is exactly accumulating? Buy stops accumulate above the first candle's close as the price entices traders during the range expansion. Then the price is manipulated by surpassing the high of the range. By entering into the distribution phase, it traps every buy order above the first candle close. This signifies an upcoming continuation towards the sell side liquidity, indicating a downside continuation. Thus, this sequence comprises accumulation, manipulation, and distribution, embracing the power of three. The rest are the same as the example that was just explained. All these patterns meet the power of three: accumulation, manipulation, and distribution. In the first step of trading using CRT, we need to look for specific candles that indicate an accumulation phase around key levels, so the higher time frame candle should be identified around the key areas. For having a high probability CRTs, they should be identified around the key times, so we should consider the candles formed at 1 a.m., 5 a.m., and 9 a.m., 1 p.m., 5 p.m., and 9 p.m. Here is a summary of the time frames you will need to switch between in order to look for the candle range and the entry in lower time frames. It's time to make a transition into the advanced phase, where we will focus on enhancing our ability to trade the candle range theory with precision. This will involve applying the liquidity price interaction theory to the candle range theory. The liquidity price interaction theory involves two concepts. The first concept is candle violation. The most important factor for each candle is the opening and closing price. When the next candle forms as the opposite colored candle, it will trade within the previous candle's range. If it trades beyond the previous candle's close, it indicates a candle violation. It's important to note that many significant market movements begin with a candle violation. In the upcoming videos, we will provide more details about the candle violation. For now, it is important to know the candle violation indicates that the price is at the start of a big move. The second concept is the imbalance, inefficiency, or fair value gap. These concepts are so similar, and they are indications of a big move in the market. The liquidity price interaction theory tells us every significant market movement represented by a candle violation and fair value gap is aimed at reaching a liquidity target. When trading a candle range using the candle range theory, it's important to identify whether the price has reached its liquidity target or not. Consider the candle range. The price at the accumulation or manipulation phases has not reached a liquidity level yet. So will you trade this candle range? I will not. If we base our trading decisions just on the range of this candle and confirmations of power of 3, the trade might fail if we don't consider this liquidity level as the target. The manipulation phase may become a pullback to push the price higher to this liquidity level. Meanwhile, consider the candle range that the price at the accumulation phase or manipulation phase has reached a liquidity level. This candle range will have all confirmations to trade. In the upcoming videos, we will discuss the liquidity price interaction theory in more detail. So before we plan to trade any candle range, we need to answer these questions. If there are fair value gap and candle violations, what are the possible targets? Has it reached its target? Most of the time, it's a liquidity level in the form of an old high or low, a resistance and support level, or supply and demand level. Imagine a candle's range. The next candle forms as the opposite colored candle, violates the previous candle, and closes at this level. We believe more than 70% of these formations have a liquidity target. If this drastic move reaches the expected liquidity level even by the next candle wick, this candle range has the expected conditions to trade. However, if this move fails to reach the liquidity level, even during the manipulation phase, it is not considered safe to trade within this candle range. Previously, we have discussed how to identify the best candle range for safe trading. Now, let's focus on how to manage and execute trades within the safe candle range. As the second step of trading CRT, we should examine lower time frames to get a closer look at the manipulation phase. There, we can apply the liquidity price interaction theory to optimize CRT. Our entry will appear at this phase in the form of an order block. My strategy involves identifying 3 monthly candles that meet my confirmation criteria. Next, I examine the manipulation phase in the weekly time frame to identify an order block for trading within the anticipated range. This is last month's Euro-USD chart. As a day trader, I have my weekly bias to identify my trade opportunity in the daily charts, which I will discuss more about in the upcoming videos. Want to dive deeper into my CRT day trading strategy? Be sure to subscribe to the channel so you don't miss any of the upcoming videos packed with valuable insights and tips from the Candle Range playlist.